Tell us, what are you seeing? What are you hearing? And what are your thoughts on this right now?
Yeah, thank you so much, Ricky. So, I mean, this is a developing situation. It's happening in real time, and we're seeing the effects of it. And in all honesty, we're getting a lot of questions, and that's why I kind of reached out as well because I thought you are probably getting a lot of questions as well. And if you're not getting questions, then I think you should be creating a conversation around this. And I'll talk about this a little bit. Is it okay if I share my screen really quick?
Please, yeah, you're all set.
Okay, amazing. Bear with me. All right. So are you able to see?
Yeah.
Yeah. Okay. Okay, guys. So what's going on right now is that there is a conflict in the Middle East. It's impacting mortgage rates. It will impact mortgage rates. It's going to impact the economy in general. Okay. So that's what we're here to talk about. So before anything else, what the impact of the ongoing conflict in the Middle East is, it all spurs from the main thing, which is oil. So you got to watch the oil. If oil prices go up, bond prices or bond yields will also go up, and bond yields are what interest rates, specifically fixed mortgage interest rates, are based off of. So if bond yields go up, interest rates also go up. And the other thing is that there's two avenues to this conflict, right? So one will be immediate risk, and the other one is going to be ongoing persistent risk. So we're going to talk about immediate risk right now because that's what we're seeing. So oil prices have already started going up quite a bit. If you've tried filling up your gas over the yesterday or day before, you would have noticed that there was a steep 11 12 cent increase in gas prices already. So what's happened? Oil prices, they've moved up quite a bit since the conflict started and escalated. The crude oil prices went up about 15 to 20% in just under a week. And that's enough to make a difference in the financial markets. So what has that done? Well, that's impacted bond yields. So higher oil prices will lead to higher inflation expectations, and that's what pushes bond yields up. And when bond yields go up, interest rates go up. So what I did before this call was I mapped it out. I looked at the dates, which is on the left corner, compared it to the oil price per barrel, and then I compared it to the bond yields. So back in February 26th, 27th, our oil prices were around $70 per barrel, and bond yields were around 2.67%. March 2nd, oil prices went up to like $78. Bond yields went slightly higher from 2.67 to 2.76. And then up till yesterday, oil prices went up to $84 a barrel and bond yields went up to 2.82%. That is a 15 basis points or 0.15% increase in bond yields in just a few days. So just to give you an idea, a 15 basis points increase in bond yields, what that means is that if it persists a couple of days or a week, then banks will start increasing their rates by 10 to 15 basis points or 20 basis points. And just to let you know, we have already started seeing that. Discretionary pricing for the banks, BMO, BMO TD, Scotiabank, they've all started giving out rates that are 15 to 20 basis points higher than they were a week ago. So this is very, very important, and this is developing right now. So it's important that you guys know this. Again, this move happened after oil prices surged due to the escalation in the Middle East, and and this is because the markets are pricing for higher inflation risk if if this war continues, right? So what's the risk factor here? Well, right now oil is around 84. Well, actually, yesterday it was around $84 a barrel. If oil reaches somewhere around $90 per barrel, this could have major consequences, right? If oil keeps climbing, bond yields could push towards 3%, which would mean that banks' advertised rates may start changing as well. So there's advertised rates and there's discretionary rates, right? Advertised rates is what the banks put out. And then you negotiate and they give you a lower rate based on the advertised rate. But discretion, we've already started seeing is changing right now. So you got to follow the oil, and that's what's happening, right? And then this is all from yesterday, right? So March 4th, which is yesterday, oil prices went up to $84 per barrel. Bond yields went up to about 2.82%, 15 basis points higher than they were. But then what happened today? Craziness happened today, right? There was a major tanker attack. And basically, after this attack, the Persian Gulf is now closed for business. So now things have gotten super serious after the most recent attack today that happened, right? What does that mean? Well, now oil is hovering at $85 a barrel right now. Just yesterday it was around 81 to 84. Now it's around 85. And hopefully it does not go up to 90, because if it does, we're going to see further pricing ramifications, right? Where interest rates will go higher. So what happens next? Well, I mean, oil prices obviously is what we're looking at right now, because that's the number one driver of inflation, and that is the biggest export that kind of matters to us right now, right? But if this war persists, if this lasts longer, then it's not just oil. It's going to go beyond that. It's going to go over to energy. So diesel, jet fuel, natural gas, like these things will get impacted. And then the bigger issue becomes shipping and trade disruption. So everything kind of connects to each other, right? And if supply chain gets hit, which actually is happening right now after this incident, the Persian Gulf is basically closed, so supply chains are already starting to get impacted. So when this happens, this will also be inflationary. Inflationary meaning things are going to cost more money than they do right now, right? And when that happens, interest rates always go up, right? So commodity prices, they could follow as well: wheat, corn, fertilizer, metals, all that kind of stuff. And then obviously, as the war persists longer and longer, more money is going to fall in defense spending, which creates deficits. Deficits creates inflation. So the circle kind of continues, right? So obviously, war is not good for anyone. And the longer this lasts, it's going to have impacts on interest rates. Now, the other risk is persistent risk, which is kind of really, really weird, because when you go into persistent risks, interest rates can actually come down. So that's right? Like when the economy gets hurt so bad that there's not enough production, rates tend to come down. So right now, interest rates are going up, right? But if this lasts longer and the effect on the economy, the global economy, is more severe, then yeah, we actually may see lower interest rates. But that's not a good news, just to be clear, right? So if the conflict starts to hinder our economic growth, things will get worse. Let me explain how that works. So let's say that oil, instead of going from $80 to $85, goes all the way to $130 per barrel. Well, then what happens is that consumption of that oil starts to stop. Businesses start to close down. They don't use as much oil, right? Things like this happened during COVID, by the way, right? So hopefully this is not a repeat of dire economic circumstances. Major disruption in global shipping. This happened again in COVID times as well. You remember, right? When things weren't coming in, it was impossible to get stuff. Car prices went insane because we couldn't import enough cars because the chips weren't being made. So kind of like the same, right? Like if supply chains are broken, nothing is coming in or out, prices start to go up. There's not enough spending happening, and there's not enough overall economic growth happening, right? So that's when financial markets start going under stress as well. So stock markets start to crash, credit markets starts freezing. There's a lot of banking stress that comes on. So again, these are very, very severe circumstances, and I'm hopefully we'll never get there, right? Hopefully this conflict will get resolved in the next few weeks. But I'm just letting you know what happens next. And obviously the ultimate risk, right, which is global recession, right? So hopefully we won't get there. But having said that, I just want to let you know things that are happening right now. We've already started seeing stock markets. Well, I don't want to say crash, but we've already started seeing stock markets go down, and we're also seeing supply chain disruptions all over, right? So Japan, China, they're all starting to feel this. But why, this is important is that you guys need to know this, because if you have any clients, like if you sold real estate to anyone in 2023 or 2024, chances are that their mortgages are coming up for renewal this year or next year, because everyone that took a mortgage, or 80% of people that took a mortgage in 2023 and 2024, took a 3-year mortgage. So those mortgages are coming up for renewal now or within the next 6 to 8 months. So make this a point to connect with those people. Let them know that, hey, listen, interest rates may go up because of what's happening in the global economy. Make sure you're talking to your banker, your mortgage person, to lock in good rates right away, right? And obviously, if you're working with clients who are shopping for a new house, this is very, very important and relevant information. You are the expert. You should know what's going on, and you should let them know as well that the interest rate market is a little volatile right now.